Here's a number I want you to sit with for a second. $2,500. That is what the IRS can charge you in a single penalty for skipping just one required withdrawal from your retirement account. Not stealing, not fraud, just forgetting, or being late, or getting the math wrong by a few $1,000s. If your required minimum distribution this year was $10,000 and you didn't take it for any reason, the IRS can hit you with a 25% excise tax. That's $2,500 gone, on top of the regular income tax you still owe once you finally do withdraw the money. And here's what really gets me. Most people who get caught by this aren't careless. They're people who forgot about an old 401k from a job 20 years ago. They're people who were in the hospital. They're people whose accountant retired and nobody picked up the file. In the next several minutes, I'm going to show you the exact math behind this penalty, a real case of someone it happened to, and this is the important part, exactly how to fix it if it's already too late for this year. There is a way out, but you need to know it exists. Let's get into it. What counts as skipping your RMD? Before we get to the penalty math, I want to clear up a misunderstanding, because this is where a lot of people get caught without realizing it. Skipping your RMD doesn't only mean withdrawing nothing at all. There are actually 3 ways people accidentally trigger this penalty. Way 1, the obvious one. You simply don't take any distribution from the account during the year. Maybe you forgot the account existed. Maybe you assumed your advisor handled it automatically. They don't always. Way 2, withdrawing less than required. This is more common than you'd think. If your RMD was supposed to be $10,000 and you only took out $6,000, the penalty doesn't apply to the full $10,000. It applies to the shortfall. In contrast, if your RMD was $20,000 and you withdrew $15,000, the penalty would be based on the $5,000 you didn't withdraw, making it $1,250 instead of the full amount. Way 3 is missing the deadline. The annual RMD deadline is December 31st every year, with one exception for your very first RMD. If you take the right amount, but you take it on January 3rd instead of December 31st, that withdrawal counted for the wrong tax year, and the prior year is now short. So this penalty doesn't require you to do something dramatic wrong. A partial withdrawal, a late transfer that didn't process in time, an account you forgot, any of these 3 can trigger it. That's exactly why I want you to understand the math next, so you know what's actually at stake. Let's get specific with numbers because vague warnings don't help anybody. The IRS generally charges a 25% excise tax on the amount you should have withdrawn but didn't. Let's run through a few real examples so this sticks. If your RMD was $10,000 and you withdrew nothing, $2,500 penalty. If your RMD was $20,000 and you withdrew $15,000, the penalty would be based on the $5,000 you didn't withdraw, making it $1,250. One financial professional gave this example. If a client was required to withdraw $40,000 but withdrew only $25,000, the $15,000 shortfall could produce a $3,750 excise tax. Now here's the relief built into this rule, and I want you to remember this number too, 10%. If you correct the issue by taking an additional distribution during what's called the correction period, the penalty drops from 25% down to 10%. Using that same $40,000 example, the $3,750 penalty becomes just $1,500 if it's corrected in time. So the difference between catching this mistake quickly and ignoring it isn't small. On that one example, it's the difference between $1,500 and $3,750. That's not pocket change, that's real money, and it's entirely within your control. Real case. What happened to Frank? Let me walk you through a real situation because numbers on a screen are one thing. Seeing how this plays out for an actual person makes it click. There's a documented case of a retiree, we'll call him Frank, age 83, who missed his RMD of $6,400 back in 2023. He didn't realize it until 2026, 3 years later, after the correction window had already closed. Because he was outside that correction window, Frank owed the full 25% excise tax, $1,600 on that $6,400 shortfall, not the reduced 10%, the full penalty. Here's the lesson in Frank's story. It wasn't that he ignored the rule on purpose. It's that nobody caught the error for 3 years. By the time it surfaced, the window to get the reduced penalty had already shut. But here's the part of Frank's story that matters most. Even at that point, the right move was still to fix it. He filed the required form with his tax professional's help and paid the penalty. Ignoring a missed RMD doesn't make it disappear. It only makes the eventual fix more expensive the longer you wait. So if you're watching this and thinking, I'm honestly not sure if I've missed one, please don't put off checking. The single biggest factor in how much this costs you is how fast you catch it. The 2-year correction window explained. Let's talk about this correction window in more detail, because this is genuinely the most useful thing in this entire video. The reduced 10% penalty applies if you fix the missed amount and file the right form within this window. So when exactly does it start and end? It begins the day after the missed RMD deadline, and it ends at the earliest of 3 possible triggers. 1. The date the IRS mails you a notice saying they've caught the shortfall. 2. The date the IRS formally assesses the tax against you. 3. The last day of the second taxable year that begins after the year the shortfall happened. In plain terms, you generally have about 2 years to fix this yourself, quietly, with the reduced penalty, before the IRS catches it and locks you into the full 25%. Once they send that notice, your window to self-correct at the lower rate is gone. That's the entire strategic point of this video. The IRS isn't hiding this window from you, but they're also not going to call and remind you it's closing. That responsibility sits with you or with whoever manages your accounts. And one more thing worth knowing, the IRS can waive this penalty completely. If the missed RMD was due to reasonable cause, illness, an administrator's error, a recent retirement transition, and you act quickly and document it, a full waiver is genuinely possible. This isn't designed to bankrupt honest retirees. It's designed to catch the accounts nobody ever deals with. How to fix it. This week's step 1. List every retirement account you've ever opened, including old 401ks from past employers. The accounts people forget are usually the ones causing the problem. Step 2. For each account, find the prior year-end balance. This is the number used to calculate what your RMD should have been. Step 3. Compare that required number against what you actually withdrew last year. If there's a gap, you may have a shortfall. Step 4. If you find a shortfall, the fix is to withdraw the missing amount as soon as possible. This is what starts the clock toward qualifying for that reduced 10% penalty or potentially a full waiver. Step 5. File Form 5329 with your federal tax return for the year the RMD was missed, including an explanation if you're requesting a waiver. This form is how the IRS tracks and calculates the corrective tax. Step 6, and don't skip this one. A licensed financial advisor or CPA can confirm your exact numbers, help you file Form 5329 correctly, and in many cases request that the penalty be reduced or waived entirely. This is exactly the kind of situation where professional help pays for itself. To be clear, this video is educational, not personal tax advice. Your specific accounts, your specific birth year, and your specific circumstances all affect the real answer. A professional looking at your actual numbers is how you get that answer with confidence. Here's the one thing I want you to carry away from this video. This penalty rewards speed. Catch the mistake yourself, fix it promptly, and the cost is cut in half, or potentially erased completely. Wait for the IRS to find it for you, and you're locked into the full amount. You don't need to panic over this. You just need 5 minutes this week to check your accounts and make sure nothing slipped through the cracks, especially if you have more than one retirement account or you've recently changed advisors, retired, or been through a health issue that pulled your attention elsewhere. If this video helped you understand a rule the IRS doesn't explain very clearly, subscribe else. Every week I break down exactly this kind of information in plain English for people in exactly your stage of life. No jargon, no confusion, just the facts. Explain the way they should be. Take care of your savings, and I'll see you in the next one.